If you are an investor in ST Engineering, you probably saw the headline that made your heart skip a beat. A massive sudden write-down, specifically a $689 million impairment loss on their Satcom business. When you see a number that big, nearly 8% of annual revenue evaporating into thin air, the immediate knee-jerk reaction is panic. You start wondering if the management has lost the plot, if they overpaid for assets, and if your dividend is about to be slashed to cover the hole. But if you strip away the one-offs, and if you look past that scary headline number, the real decline isn't there. In fact, the real story is completely different. Hidden behind that impairment is a $32.6 billion secret weapon and a dividend payout that has quietly hit a 5% yield. This is a much more complex story than it appears, and it fundamentally changes how we need to look at this Singapore blue chip. I'm Iggy, your Singapore-based market analyst, and my job is to cut through the noise, specifically the noise that mainstream headlines love to generate, and show you what really matters for your CPF, SRS, and SGX portfolios. And we've been putting in the work. Since October 2025, this channel has produced over 1,200 videos with more than 600,000 watch hours. We were also honored to be ranked 8th in Tiger Broker's 2024 Influential Tigers. My focus is always on regional and global trends to give you that broader context so you can uncover hidden gems and potential pitfalls. Today, we are going to do exactly that with a deep dive, slide by slide, through ST Engineering's 3Q 2025 results. We are going to figure out if this is a trap or the dividend opportunity of the year. Let's start our methodical breakdown by looking at the group highlights. This is the big picture. ST Engineering reported revenue for the first 9 months of 2025 at $9.1 billion. That is a 9% increase year on year. In the third quarter alone, revenue climbed 13% to $3.1 billion. Now, on the surface, 9% growth for a mature industrial giant sounds good. But we need to define what growth actually means here. There is a critical detail that many retail investors miss. The company divested, meaning they sold off their Liboy business in the third quarter. When you sell a business unit, you lose its revenue stream. So, to understand the real health of the company, we have to look at organic revenue. Organic revenue is the money the company makes from its core, remaining businesses. If we strip out the Liboy divestment distortion, the actual organic revenue growth was 10% for the 9-month period. Why does this matter? Let me give you an analogy. Imagine you run a hawker stall selling noodles and curry puffs. Your total sales go from $100,000 to $105,000. It looks like 5% growth, but imagine you also sold off your entire curry puff station for a lump sum of cash. Are you really growing or are you shrinking your footprint? In ST Engineering's case, the core noodle business, the aerospace and defense parts, is actually growing at 10%. That tells us that management is actively cleaning up the portfolio, selling off the side dishes to focus on the main course. For us as Singapore investors, this is exactly what you want to see. You want a business that is accelerating its core engine, not just inflating numbers by buying random assets. Now, let's move to the next slide and break down the revenue by segment. This is where we see exactly where your dividends are coming from. ST Engineering stands on 3 legs: commercial aerospace, defense and public security, and urban solutions and Satcom. Firstly, let's look at commercial aerospace, or CA. This segment grew 11% to $3.6 billion. In a post-pandemic world, this is the star performer. Why? Because of MRO. MRO stands for maintenance, repair, and overhaul. It is the unglamorous but incredibly profitable business of fixing planes. Airlines are flying more, their fleets are aging, and engines need constant servicing. That is money directly in ST Engineering's pocket. However, there is a but here. The company noted that PTF revenue, that stands for passenger to freighter conversions, partially offset these gains. During the pandemic, turning old passenger jets into cargo planes was a goldmine because e-commerce was booming. That market is now cooling off. From an Iggy perspective, this is the real headwind we need to watch. If the conversion business slows down too much, it could drag on the aerospace growth in 2026. Next, look at defense and public security, or DPS. This hit $4.0 billion, up 9%. This is the fortress. This segment is built on government contracts and long-term relationships. They won $6.6 billion in new contracts just in the first 9 months. For Singapore investors focused on dividend sustainability, this segment is your safety net. Governments don't cancel contracts because the stock market had a bad week. This is sticky revenue. Then we have the third leg, urban solutions and Satcom. Revenue reached 1.4 billion, up only 5%. Honestly, this is the laggard. This is the black sheep of the family right now. This segment contains the Satcom business, which is responsible for those massive impairment charges I mentioned in the hook. They took a $689 million write-down on iDirect Group and JetTalk. Let's analyze that write-down. An impairment charge is basically management admitting we overvalued this asset and now we have to admit it's worth less. It hurts the balance sheet today, but it doesn't necessarily burn cash today. The cash was spent when they bought it. The write-down is an accounting cleanup. While it looks ugly, it tells you that the Satcom market isn't playing out as they expected. For us, this confirms that ST Engineering is fundamentally a defense and aerospace company first. Urban Solutions is a smaller, riskier bet on smart cities. If you are buying this stock, you are buying it for the first two legs, not this one. Now, let's go deeper into commercial aerospace because the numbers here are fascinating. Revenue jumped 22% in the third quarter alone. They won 1.4 billion in new contracts in just 3 months. What's interesting is the type of contracts. They secured a multi-year Airbus A380 heavy maintenance contract. The A380 is that massive double-decker plane. Maintaining those is complex and expensive, which means high margins for ST Engineering. These contracts run for 5 to 10 years. This isn't a one-off sale, it's recurring income. But here is my perspective on the risk. We are 2 years into the post-pandemic recovery. The explosive growth phase of airlines bringing planes back from the desert is mostly over. We are reaching a steady state, so that means the easy growth is gone. If you are banking on this segment growing at 20% every year forever, you are going to be disappointed. We need to be realistic that this segment might plateau in 2026. Let's switch gears to the fortress, defense, and public security. The contracts here are things like AI-powered 5G solutions, cybersecurity systems, and ammunition. I'll be direct with you. This is not sexy. Selling ammo and secure data transfer products isn't going to make for a viral TikTok video, but it is where the dividends come from. Governments buy security and resilience. They don't shop on Shopee for the cheapest tank parts. The order book for this segment alone is over $20 billion. Think about that number. 20 billion. That is visibility into revenue for the next 5 to 7 years. For a dividend investor, that is extraordinarily valuable. You aren't guessing if they will have customers in 2027. You know they will because the contracts are already signed. The only real risk here is geopolitical shifts or budget cuts. But in today's world, defense spending is trending up, not down. Now, we have to address the ugly part again, urban solutions and Satcom. Why did they take a $689 million hit? It's because iDirect Group and JetTalk, their satellite communications businesses, are failing to meet growth targets. Technology in the satellite space is moving incredibly fast. With players like Starlink disrupting the traditional models, ST Engineering clearly bet on the wrong horse or paid too much for the horse. However, looking at the smart city side, rail systems, smart traffic lights, toll systems, that is growing but slowly. 5% growth isn't enough to move the needle for a company of this size. If you are holding this stock, you have to accept that this segment is currently a drag on performance. This brings us to the most important number in this entire script, the order book. As of 30 September 2025, the order book stands at a record $32.6 billion. This includes $14 billion in new contract wins just in the first 9 months of the year. Let me define what an order book is for the new investors. This isn't a sales forecast. This isn't a hope and pray number. These are signed contracts, obligations. This is cash that is contractually obligated to come into the company over the next few years. For a CPF or SRS investor, this is the holy grail. You don't want potential value. You want contracted. A $32.6 billion backlog essentially guarantees a baseline of revenue for years to come. It acts as a floor for the share price. Even if the economy enters a recession, these contracts, especially the defense ones, are likely to be honored. Now, let's look at how they are managing their money. Capital allocation. We talked about the impairment, but they also divested Liboy, SPTel, and CityCab, raising $594 million in cash. Here is the honest truth about what they are doing. They are cleaning house, they are selling the businesses that don't fit and taking the pain on the ones that fail, like Satcom. They are using that 594 million cash to reinvest in the high growth areas and crucially to reward shareholders. This is a sign of disciplined management. They aren't pretending to be bigger than they are trying to be more efficient. And that efficiency leads us to the part you all care about most, dividends. For FY 2025, ST Engineering has declared a total dividend of 23.0 cents per share. That is broken down into 3 interim dividends of 4 cents, a final dividend of 6 cents, and a special dividend of 5 cents. Let's do the math together. If you buy the stock today at around $4.60, a 23-cent payout represents a yield of approximately 5.0%. In the context of Singapore, that is jaw-dropping for a blue-chip defense stock. Your CPF, ordinary account, pays you 2.5%. A Singapore T-bill might get you close to 3% depending on the auction. This is giving you 5% backed by a government-linked entity with a $32 billion order book. But it gets better. Starting in FY 2026, they are changing the policy. The new policy is a base dividend of 18 cents per share plus 1/3 of any year-on-year incremental net profit. This is a massive shift. It means your dividend is now directly linked to their growth. If they grow their profit by $500 million, shareholders get 1/3 of that upside distributed as cash. This aligns your incentives with management's incentives. If they win, you win. Finally, let's look at their ambition, the 5-year targets. They want to double group revenue to $17 billion by 2029. They want commercial aerospace to hit $6 billion and defense to hit $7.5 billion. Is this realistic? To hit $17 billion from a base of $9 billion means they need to grow at roughly 17% compounded annually. That is aggressive. They are assuming they will grow at 5 times the rate of global GDP. From my perspective, this is the stretch goal. I don't think you should invest expecting them to hit 17 billion perfectly. But even if they miss and only hit 14 or 15 billion, the dividend growth from that expansion would still be phenomenal. You are betting on the direction, not the exact destination. So let's bring this all together in Iggy's assessment. Here is what is working. The balance sheet is being cleaned up. The order book is a fortress at 32.6 billion. The commercial aerospace recovery is generating cash right now, and the defense segment provides unmatched stability. The 5% yield is attractive and beats almost any fixed income instrument available to Singapore retail investors right now. Here is what is not working. The Satcom business is a mess and a money pit. The passenger to freighter conversion market is cooling, which could hurt growth next year. And the urban solutions segment is growing too slowly to matter. In terms of valuation, at a price to book and yield perspective, trading around $4.60 is fair. It's not dirt cheap, but for a quality compounder, you rarely get dirt cheap unless the whole market crashes. Now, let's talk about the price. You'll remember we had that 1-for-2 share consolidation back in late 2024. This was a technical move that doubled the share price while halving the number of shares. Our old aggressive buy target of $4.20 is now mechanically $8.40. As of today, the stock is trading around $8.65. It's sitting just above our original aggressive buy zone. It's no longer on sale, but it represents a fair value entry. The CGS international target is up at $9.50, which aligns perfectly with our old nibble range. The deep value play is over. This is now a fair value play on a high quality growth and stability stock. So here is my final recommendation, split into 2 parts. For existing unit holders, hold. Absolutely hold. You are being paid a total of 23 cents per share this year, which is a solid yield, and you are holding a company with its largest ever order book. The thesis is playing out perfectly. Do not be scared by the impairment headline. It's the first step to solving the company's biggest problem. For new buyers, the thesis remains a buy, but the backup, the truck discount is gone. I would nibble here at $8.65 to start a position, but save my aggressive buying for any dips. If the market gives us a pullback back towards that $8.40 level, that in my view would be the time to add aggressively. This isn't a lottery ticket, it's a core allocation play. You need a multi-year time horizon. You need to be comfortable with aerospace and defense exposure, and you need to be willing to hold through cyclical wobbles. But if you want a heavy hitter in your Singapore portfolio that pays you to wait, ST Engineering is checking all the right boxes. If you found this analysis valuable and want to go even deeper into the numbers, consider becoming a free or paid subscriber to the Investing Iguana on Substack. We break down the stocks that matter to you without the fluff. You'll be in good company. The Investing Iguana has now hit over 1.3 million reads with 65,000 likes across our platforms. We're also thrilled to welcome our growing community of over 30 YouTube Premium subscribers and 19 paid Substack members who make this in-depth independent research possible. Thanks for watching, and I'll see you in the next analysis.